Well, thank you so much, Sarah, for jumping on here with me today. I really appreciate your time. I know you guys are probably really busy on your side too, and really appreciate you taking the time to go over credit. I think it's a big topic that a lot of people think that they may even understand. And then when you get into it, you realize what may make sense isn't how credit really is, right? So
Absolutely.
I think it's important just to understand what is credit, how does it really work, what are the best practices so that we can all be in a position to make good financial decisions and have good credit that's going to end up saving us more money down the road.
Yes, yes, I totally agree.
So if you want to give a quick introduction about yourself, I know I have your information here, but just kind of a little bit about you and Blue Water Credit as well.
Yeah, so again, yeah, my name is Sarah Perkins. I currently work as a credit education specialist and a debt resolution advocate for Blue Water Credit. I've been with them for about 8 years now. They've been around since 2008, but I've actually been in the credit and debt space for well over 20 years. So took my experience from working with a collection agency and a debt buyer and learning the whole collection process, everything from collections, lawsuits, judgments, liens, the worst side of collections, and then jumped ship and went over to debt settlement, where I became more of an advocate for consumers to help them settle their debt. And then that's what I primarily do for the clients at Blue Water Credit that have debts that need to be settled in conjunction with us disputing negative items on their credit. So,
Yeah, I think I reached out to Jeff the first time. It was probably right after 2008, 2009. So I've known him for a very long time and
yes,
worked with Blue Water Credit for a very long time. There's so many different credit agencies out there, and it's very scary. Some
it
of the
is.
horror stories that you hear out there. So it's really important that you're working with people that have been vetted and that you know are going to do a good job.
Yeah, what I share with people too is, 99% of the people that claim to be doing credit repair out there are probably doing it illegally. And when I say that, I mean, we have to be licensed with the Department of Justice. We need to be bonded. There's very strict rules in how we collect fees. And so that's the one plus, major plus in working with Blue Water Credit and Jeff and Natalie is they make sure that they're doing things the right way, the ethical way. We're not just doing blanket disputes of fraud and seeing what sticks. You're really getting people that know credit inside and out, know the statutes, know how to dispute these things properly so that when we do get them removed, they stay removed off of your credit report. And then helping you understand credit while you're going through our program too, because the dispute part is just one piece of the puzzle when it comes to credit. There's so many areas, and a lot of it is dependent on the consumers doing the work. And hopefully, we'll go over those kind of things today to help people understand what they can be doing on their own.
Yeah, I love that. And I think that's the big part too, is that a lot of times these other agencies or you get information that says, oh, just dispute it. And let's
Hmm.
say that your goal is to purchase a home. Oftentimes you can't have a disputed account
Yeah.
depending on what you do. So it doesn't help you, meaning that when you dispute the account, it may look like you're helping yourself,
Yep.
but you have to take it back out of dispute if you're
Yep.
trying to get major financing most of the time. So doing it correctly
Yeah.
is such a huge important part. And that's why I love working with you guys. I know that
Yep.
you guys are doing things the way that they need to be done, but also the best way that they need to
Yes.
be done to ensure long-term success. So
Yes.
thank you so much for
Mhm.
diving in here.
Yeah.
So really the goal today is just going through understanding credit, building credit, also, maybe starting out with credit and, bad credit and things that you can do to help your credit.
Yeah.
Understanding credit is really important because all credit is different in the way that it's viewed. And if you talk to somebody and say, oh, well, just pay it off and close it, that might seem like a logical thing to do, but it can really be hurting you. So understanding that is really going to be giving you financial power long term, not just to have good credit, but what does it mean to have good credit and why is it important to have good credit? So really understanding it's just borrowing money, right? So it's just a promise to pay back and then you're being rated on that. I always like this analogy, and it says, credit is kind of trust, and it's always when someone returns something to you that you borrow, then they trust you, right? It's the
Yeah.
same thing with credit. When you're looking at the credit report, it's the same thing. You're borrowing, repaying. And really that's what it is. It's giving a snapshot at your ability to be able to repay those debts.
Yeah, and then you can go from credit cards to then the auto loan to home. So you get to go higher up in the level of trust that you can build, but you have to start somewhere first.
Exactly. You're not going to go lend $100 to somebody where you have no basis of it,
Yeah.
right? Now, if you're family and you've built that rapport and that trust and you know that they're the type of person to repay it, you're likely to let them or not let them, depending on what your experience is. And a lot of people I come across, I've been in the industry and mortgage for over 20 years, and there's people that have come to me and they just had no credit. They were, brought up in the era where they're like, I just don't want to owe on anything. I never took out a credit card, zero credit. Now,
Yeah.
we may have some non-traditional things that we can do and loan programs to be able to still offer financing, but it usually comes with higher rates,
Yeah.
higher cost. And so understanding that you need to have credit, unfortunately, in our environment is something that a lot of people get frustrated with as well, because they're like, well, I don't want to have to charge things. I don't want to have to pay interest. And you
Yeah.
don't have to, right? It's
Yeah.
just understanding how it all works, understanding the game of it so that you can have good credit, but there are some perks that you can do with
Yeah.
it too, which we'll talk about. So really, you need it in everything. Even just going and renting an apartment nowadays is almost as much as buying a home.
Yeah.
People are like, "Man, I was looking for a place, and it was just as much as getting qualified for a home purchase."
Yeah. Yep. Yeah. And like you have here for employment insurance, I mean, almost everywhere you go, they're using your credit to somehow rate you or, show that your basis for repaying or just the trustworthiness.
Yeah, and it impacts how much money you pay for borrowing the money when you need the big ticket items. And it can, I mean, it'd be a huge amount, thousands and thousands of dollars that you could be paying in interest and fees because you don't have an established credit and they
Yeah.
don't know what your ability to repay is. So it's really important understanding that's why we need credit. And
Yeah.
even if you don't want it, you want to fight it, people are like, I'm not doing it, and
Yeah.
then a couple years later, like, okay, I opened up an account. You have to. And the sooner that you're able to do that, and the sooner you're able to teach your kids how to do that, the
Yeah.
better position that everybody is going to be. If
Yeah.
you could take just a kind of a few moments and go over the differences here of, the Vantage versus the FICO scoring models, and that way we can really understand the differences between them, that would be great.
Yeah, so I tell people there's two main players right now in the credit game, and that's Vantage and FICO. So FICO is the most well known. It's been around for ages. And what they did is they are a company that pulled the information from the three major credit bureaus, TransUnion, Equifax, and Experian, and then developed a scoring model. And that, like I said, has been used in 90% of lending decisions. Well, the credit bureaus really didn't like the idea of somebody else controlling it. And so they kind of wanted to get into the game. So they created their own scoring model called the Vantage score. So both scores have like a same range from 300 to 850. They both primarily look at the same type of areas, whether it be, your payment history, are you paying on time? How much debt do you have compared to like your credit limits, the age of your accounts, the mix of credits? They just put different values on how much they weight the importance of those things. So this is why you can see a huge difference between looking at Credit Karma, which a lot of people are familiar with, that uses the Vantage score, and then all of a sudden you go to your lender and they pull it for a home loan, and you're like, why is there like a 50-point difference? And again, it's just those little differences, like you can see on this pie chart right here. Vantage weighs your payment history at 40% and your credit utilization at 20%, where if you look at FICO, the payment history is 35%, so a little bit less, and then they put a little bit more weight on your credit utilization. So those differences, if you are, lacking in those areas, can cause, a sway of sometimes 50 to 100 points one way or another. Other than that, Vantage score, the one advantage with that one is you only need 1 month of credit history to develop a score, where FICO, they want you to have 6 months of credit history. So if you're thinking about going and making a purchase, you're not going to have a credit score right away. You're going to have to build that credit over, 6 months or so before you can even develop a score with FICO. Um, but yeah, other than that, they are very similar. There's just some small nuances that can cause, the difference in the scoring model. So you need to make sure, if you're looking at a score, are you looking at a Vantage score? Are you looking at a FICO score? And then even within both of those, they have different versions, whether you're going and purchasing a car, getting a credit card, or a home, and there's differences between each version as well.
Yeah, we get that all the time. We're like, oh, I know my credit score is this. And, I'm like, well, that's your credit score that you see. Where are you seeing it from? Because there's
Yep.
different algorithms. And
Yep.
it's so frustrating because you think you're doing great, you're working
Yeah.
towards things, and you're like, I'm finally over that 700 that I
Yeah.
really wanted to be at. And then, you pull credit for a mortgage and sometimes it's
Yep.
lower. I have seen the opposite though. I
Yes.
actually have seen it where their credit score is higher than what they've seen. So it doesn't necessarily mean that it's the opposite and that it's negative.
Yes,
And it's
absolutely.
always good for monitoring. At least you know the direction
Yes.
that it's going. That's why I would say it's like, even if it's not where it's going to end up, at least you know it's going up or down when you're
Yes, you can
monitoring it,
see
which is
that, yeah,
super
you can
helpful.
see the trends, you can see if you're missing payments, you can see balances and stuff like that. So it is good for educational purposes, but if, for big purchases, you may want to make sure you're looking at the right score. And then, yeah, like I mentioned here, this is just FICO itself right here has different versions. So people, I had it today where I spoke and someone's like, oh yeah, I get my FICO score sent to me every single month and my bank sends it to me. And I said, let's pull it up. Let's look at the small print. And sure enough, it says FICO score 8, which is just the most widely used score. And it's not even really used in any lending decisions. It's more of that educational credit score that's put out there where a home, you have the scores 5, 4, and 2, then there's a separate one for auto and a different one for bank cards. So things like I say the FICO score 8 is more forgiving on one-off lates. If you just have one late out of nowhere, it's not going to hurt you as bad as if you have multiple lates. But in the mortgage score, a late is a late. It doesn't matter. So that first
Right.
one, you can see a dip of like 80 to 100 points overnight, and people are just amazed at how fast you can lose your credit score with just one little hiccup like that.
Yeah, I mean, late is a big deal. I always say it's, easy to do, but it's years to recover from. So
Yeah,
always setting up
exactly.
minimum payments, which we'll talk about, or minimum auto, pay
Yeah.
from your credit card, things like that that you can do to protect yourself because it's hard. Even
Yeah.
if it's $10, they don't care that it's $10.
Yes,
Rating that it's a
exactly.
late. They're like, you
Yep.
didn't pay your bill. And it's like, but it
Yep.
was $10.
Yeah, and
uh,
this visual right here is just a good way you can see just this. We call this guy Bob, and we pulled his credit report from FICO and Vantage and from all three bureaus and all different versions, and you can just see the variation it's in score across the different bureaus, or whether or not you're looking at an auto loan or a mortgage. I mean, you could see on the TransUnion, the difference from low to high is 72 points. Same with Equifax. So, and the things that can cause those variations or, date that it's pulled, one day can make a difference. One account can update a balance and it could sway you one way or another. Not everybody is reporting everything on the same date. So, again, it really is dependent on what day are you looking at it, when's the last day it's been updated, what version that they're using. And not all creditors report to all three bureaus. It costs money for them to report. So I've seen things like those Affirm accounts. You don't always see those across all three bureaus. So sometimes that's giving you help in one credit score, or it can then hurt you if maybe only a collection is reporting on one and not the others. So you have to look at those things. And then there's always just errors. So there's anytime you are sharing information across different platforms, information can get transcribed or messed up, or a name can be incorrect, or a social security number can be incorrect, and which can cause it to pull incorrect information or incomplete information. So that can be a reason for the variations in scores as well.
Yeah, I mean, I've seen, and the thing is too, when you're buying things that you have to be prepared for ahead of time, but even when you're pre-approved, meaning that you're actively looking at homes, it could take some people, 6, 12 months to find a home. And so it's really important understanding your credit score today. If
Hmm.
you don't keep things positive, if you start maxing out cards, if you open, close, that can impact your
Yeah.
approval. And having that education for them up front of don't do this
Yeah.
is really important, and
Yeah.
that they listen to that. But, one of the things that I get often is, because you just said like it just depends on when you pull the new report, right?
Yeah.
So let's say that the report is expired and we go pull a new one, and they happen to charge, let's say it's a $5,000 limit, and they made just this one quick purchase that they were going to pay off in cash because they have the money. It's just
Yeah.
that they want the points, right?
Yeah.
So they're like, I made this purchase, but I'm paying it right off. Well, if we pull credit when it has that balance on there, it could impact the score,
Yeah.
even though their intention is to pay it off. So
Yeah.
really being aware of that and hyper focus on that, depending on what you're doing moving forward, is important, because like you can see here, the credit scoring model is huge on payment history and
Yeah.
utilization. And so
Yeah.
that's a very big part of, charging, repaying, and your balance limit ratios and all that
Yeah.
kind of stuff that you're looking at there.
Yep. Yeah. So this is kind of a good visual of really the components that make up a credit score. So this one in particular is the FICO model, not the Vantage one, but yeah, 35% is the biggest piece there, and that's your payment history. So when you have things like late payments, a charged off credit card, collection, or bankruptcy, all of those are a reflection of your payment history. And so when you have those one-off things, again, you can see a score drop 80 to 100 points with a matter of 24 hours. The next is credit utilization. And what that simply means is what are your balances compared to your credit limit? So if you have $1,000 balance or $1,000 limit, we usually suggest to tell people keep it between 0 and 10%. So that's going to be between $0 and $100. When you start going over 10%, you're going to start getting some deductions in your points. So they don't want to see you maxed out on your credit cards. And we'll talk about it later, but we have people all the time pay their credit cards off each month and they're not understanding why their utilization is so high. And again, a lot of times those balances have already been reported and then you pay it off after the fact. And so it's just understanding the dates that go along with that. The third largest piece of the pie is going to be age of accounts. So FICO is looking at the longevity of your accounts. How long have they been open? How many accounts do you have? They're looking at least for an average of 6 years or more when they take the length of all your credit cards. So when you start closing old accounts or opening too many new accounts, that is really going to have an effect on that average age that your accounts have been open. So, and we'll talk about that a little bit later. And then mix of credits, having a good mix of having credit cards, having an installment loan, something like an auto loan, a personal loan, or a student loan, and a mortgage. So I'm sure you've seen this before. People think they're doing something financially responsible and pay off an auto loan and then go, why did my score tank? And essentially it's because now you don't have an installment loan that's active on your credit report anymore. So there is some difference between doing something that's maybe financially responsible, but also knowing the game of credit and how to play it. And so you don't want to make major changes or decisions like that, especially when you're in the middle of the home buying process. And then last, inquiries or new credit. So anytime someone pulls your credit with end result of maybe offering you a credit card or a loan, you can get hit anywhere from 1 to 5 points. It doesn't sound like a lot, but I'm sure you've seen it where sometimes people have been right on that border, and that makes either the difference of them getting the loan or not, or paying a higher or lower interest rate. So every point counts when it comes to credit. And then yeah, if you open a new account, then you're getting penalized until that account ages, until at least it's been 6 months.
Yeah, I mean, a couple of frustrating things about that is that, if we go to student loans, right?
Hmm.
This is one of my biggest frustrations around credit because oftentimes with student loans, they just consolidate them without your approval, right? They
Yeah.
close them off, they start new ones, and so you have all of these accounts are open close. It looks like you're overbalanced because now the
Yeah.
the interest has put you over the amount. I've had people have perfect everything else except for their student loans they keep carrying on,
Yeah.
and their credit scores are can't even get over 700 because they just these student loans that keep doing it, and it's super frustrating. But
Yeah.
they're an installment loan, which means once that account is paid off or if it transfers to another one, it closes. It's
Yeah.
not like a credit card where it can stay open and revolving. So if it
Yeah.
closes, it's a closed account, even if you
Yeah.
didn't initiate it, and even if it's the
Yeah.
same one that's being transferred, same with mortgages. So
Yeah.
those things you can't prevent, which is why it's really important that you make sure to do all the other things to make
Yeah.
sure that you're staying positive on that, because yeah, that's super frustrating when you're trying to do that. The other one is with credit cards and how long you've had the accounts. I have people all the time where they have a little limited history, but they had previous credit cards that were closed, and I'll
Yeah.
ask, why did you close those? Oh, I was paying an annual fee.
Yeah.
Well, if you're trying to build credit or you need a higher credit score, it's probably worth the 80 bucks a year to keep it open so that you have the history. And sometimes you may be able to call them and
Mhm.
negotiate something if you've had it for a long time and have better credit maybe on those without closing the account and giving you a new card. But
Yeah.
those things people wouldn't you wouldn't think anything about that. You're like,
Yeah.
what does it matter? I have another card that I'm paying on, and history matters.
I know I shared today that I have this First Premier card. It's probably one of my oldest cards. I was having to rebuild my credit and I really don't spend anything on it, but they charge a $6 fee every single month to just pay the $6 fee from last month. And people are like, well, why keep it open? I go, well, $6, 12 months, $72. But you know what? That is saving me so much money and keeping my credit score up. It's a small investment to pay to keep that credit history open. So that's why I do
Yeah.
it.
Yeah, I agree. I mean, another one is charge-offs, because
Yeah.
charge-offs still count in your payment history. I've had it where it was a requirement and a charge-off had to be paid off for lending. So
Yeah.
they paid it off and then they require a rescore to show that it's charge-off. Yet
Mhm.
now the credit score dropped even though it's been paid off because they lost that entire history that was
Yeah.
still reporting.
Yeah.
And so making sure you're working with somebody in anything that you're doing in space, whether it's auto or mortgage, that understands credit before you take action is really important. And don't do anything until you have a consultation with someone
Yeah.
initially beforehand. A lot of people are like, well, I didn't want to waste your time. It's not.
Yeah.
Even if you have a call with us and we talk through it and you don't buy for another year, you're going to be in a good position.
Yeah.
So making that initial call is huge.
Yeah, because once you make one of those decisions, you can't take it back.
Yeah, that exactly,
Yeah.
exactly. And this was one of the things that I really loved, and would love to talk through this with you as well as any information that you have, currently in time, the CFPB, restraints and stuff like that. If you have any information on how that impacts here, I have been seeing more education on, as soon as if you see the medical that you should go in and dispute it. So your take on this currently and your thoughts around it.
Yeah, so this bill right here, this one was specific to California that went effective January this year. I know there are a couple states out there as well that do have the same kind of laws that went into effect, and it's supposed to be nationwide here. My understanding, if it isn't already, it's in the works, but it's medical debt no longer being able to be reported on your credit report. And I think this is such a great thing. It's gone through a couple steps. A couple years ago, they made a huge change and said, hey, paid medical collections, once you pay it, taking it off automatically, because a lot of people don't understand, even if you pay it collections, they are legally able to keep it on your credit report. Just because you paid it off doesn't mean they have to delete it. So that first requirement of paid medical collections being deleted was huge. And then they also changed it if it was less than $500, then they weren't going to report it, which was huge because I saw people missing a $25 copay that went into collections and it tanked their score 100 points. But this one by far is the biggest one, is saying that even if it's a $10,000 medical, that it's not, it shouldn't be on your credit report. They saw it was unfairly penalizing people, especially in certain demographics that maybe didn't have health care coverage, or it can be very confusing. I tell people my son broke his arm this last summer. He had over $100,000 in claims and he's double covered. And I'm sitting here getting bills every single day, having to fill out paperwork because claims are being denied. I could have easily gone into collections, and I know the process inside and out and how to stay on top of it. So yeah, if you do see medical collections on a credit report, definitely dispute it. That is something that we can definitely help, because it shouldn't be anything that is going to impact your ability to get a loan.
I think that is huge. And when we get to the portion of how you can go and pull a free credit report,
Mhm.
just start circling anything
Yep.
that's on there. And that way you know what you need to start addressing. It's going to be a huge relief. And I am seeing that they are still on there. So unless you're
Yeah.
proactively looking, they
Yeah.
didn't just go back and say, oh, let's take everybody's off, I don't think,
Yeah.
because I'm still seeing some of them. So you definitely want to be proactive and looking at that. And I agree. I mean, I was in the same position. I had ACL surgery last year. We're covered, and our bill almost went to collection because it had issues with the billing. And you just anybody can be impacted on it. And then once it's there, it's not fair. I agree. So I'm glad
Yep.
that that was a huge change that
Yep.
I believe needed to happen. So it's important to understand that that's available and how it works.
Yep.
Another change is going to be the FICO T10. So maybe if we
Mhm.
can chat about that as well.
Yeah, so this has been something again in the works for the last like year or two. Things kind of keep getting pushed back, but how I mentioned earlier that FICO is the main player in the game. It's used in 90% of lending decisions. Vantage has definitely put its best foot forward, and there it has been approved to go to these two new scoring models. So the 5, 4, and 2 have been the one that's been used since the dawn of time for mortgage lending, but they're seeing there needs to be a change. So the FICO 10T is the approved model for FICO, and then Vantage 4.0 for the Vantage model. So it's going to go to two scores there. And the biggest difference that we're seeing is it's allowing trending data to come into play. So Right now, when you look at a credit report, you're looking at just a snapshot. Whatever is on the page that day, that is what you are getting judged on. But now it's going to start going back and looking like, what has been your behavior for the last 24 months? Have you been paying down your credit cards over time, or did you just happen to pay them all off last month, trying to trick the system? So it's actually going to reward people that are being responsible with their credit card debts and making responsible decisions. um, we're seeing that, one of the big things that we say right now is you can move credit card debt onto installment loans so you can lower your utilization. We're seeing that that might be a change, that they're going to just see that you're moving one debt to another and not give you like the points for that. So there are some downfalls. So we're on top of staying on what the big changes are going to be, but we're seeing that moving revolving debt to a personal loan may not necessarily help or have a good impact on your score like it used to be. But the positive is credit scores are going to be now available sooner for people, because the Vantage only takes 1 month of credit history. So these people that are new to the credit game or trying to get into it don't have to sit around and wait the 6 months. They're also going to allow utilities and rent payments to they can be added to credit reports right now. They aren't counted in the mortgage scoring model, but they will be counted in these two models. So again, people that didn't want to necessarily play the game and, take out debt on credit cards, there's going to be alternatives to show their trustworthiness by showing their payment history on their cell phone bill or their rent that they're paying, and actually get credit for that to get a home loan. And all in all, what they're hoping is it's just going to make more consumers eligible for home loans. So it's going to open up the doors, but they want to be careful that they're still, it's still responsible lending after what happened in 2008, 2009. They don't want something like that to happen. So this is why I think we've gotten a little pushback as far as when this is going to go live. Last I heard, they were taking loans for the last 30 years and applying these new scoring models to it to see if would this loan have gone through with the new scoring models, and kind of just looking at raw data that way to make sure it's still fair, but still also going to help people that, again, don't have traditional credit enter into the home buying game.
Yeah, I think that the overall idea of it is great because they don't want people to have to wait so long to be able to show their ability to repay. So I think
Mhm.
that's great. I think the big takeaway from here, and the reason I really wanted to go over this, is you cannot wait to rebuild your credit. You
Yeah.
cannot wait to take control of your credit and start
Mhm.
making better decisions now that you have the information.
Mhm.
As you had said, used to be that today we could just go
Mhm.
pay down credit cards. It reports the next time that it reports within
Mhm.
30 days, your credit score jumps, everybody's
Yeah.
happy. That's not going to be the case with it's
Yeah.
now going to take a little bit longer. Now, can you pay them down and wait some time so that you have the trend? Yes.
Mhm.
But they want to see that you can be consistent in keeping them down, because the
Yeah.
problem was people were doing that and finding a way to pay them off. There a lot of, they call it creative
Yeah.
strategies that
Yeah.
were going on to do this, but then people would get in the home and recharge them and weren't
Yeah.
able to pay. So they want to make sure that you're in a good position. It's not a bad thing. It's just now we're not going to have a lot of flexibility with
Yeah.
it, with being able to get your credit score up higher sooner, unless there's
Yeah.
inaccurate information that
Yeah.
we can get removed, which is really important to understand on here.
Yes.
Now, I did want to touch on this too, the types of, credit pools, because there are different ones. I know we chatted about part of the credit scoring model is inquiries too. So maybe if you want to go over these three and talk about the impact of credit on those as well.
Yeah, so I mentioned, it's a small portion of a score, but it can be very impactful, 1 to 5 points. So whenever you have credit pulled, it's either going to be considered a soft inquiry, a promotional inquiry, or a hard inquiry. And depending on that inquiry, it's either going to affect your credit score or it's not. So soft inquiry is where you pull your own credit. So anytime you go on any of these sites, and some of the sites I'll mention later, where you're pulling your own credit and looking at it for your educational purposes, you're not getting penalized for that. Or if you are having an employment background check, employers looking at it to figure out, if you're a good candidate, and your payment history to judge you on that, that's not going to impact your score. Promotional inquiries are basically, I tell people, when you go apply for credit, your information is sold to the masses. And then those people can then come and I don't want to call it predatory, but they can then try to lend on the basis of, your credit being the information that's been sold to them. So I tell people opt out of that. It doesn't impact your score, but when you go to buy like a home or a car, you're going to get inundated with a lot of different people calling you that are going to confuse you and prey on the fact that maybe you don't know that this was your lender that pulled it and somebody else did. It's a real easy process called optoutprescreen.com. Go on, fill in like your name, date of birth, social. It takes a couple days to go into effect, so make sure you do it a couple days before a lender pulls your credit, and then it's usually good for 5 years. You can opt back in at any time. And then lastly, hard inquiries. So this is where your score gets impacted anywhere from 1 to 5 points is when you go apply for credit, whether it be a credit card, an auto, a mortgage. That is where you're going to see that dip of 1 to 5 points. But keep in mind, most loans, when you're shopping, you do have a rate shop window where it only penalizes you for that one pull, even though you might shop and have 3 different lenders pull your credit during that time.
And that's staying within one industry though, because it's that one
Correct.
algorithm. So like if you're shopping for a mortgage, you have that window, but you don't want to be shopping for a mortgage and an auto loan because those are two separate types of
Yes.
algorithm. Because now they're like, oh, you're just out shopping.
Yep.
So making
Yep.
sure you stay within the window of where you are. I know when looking at mortgages, we have the option to do hard or soft inquiry
Yes.
at pre-approval. There are some additional requirements depending on the type of financing where we may need to do a hard inquiry, but I tell my clients all the time with an option, soft inquiry is definitely the way that we want to go initially. It, has some additional costs, but
Yeah.
you don't want to do it unless you have to do it when you're ready to buy.
Yeah. And then I tell people if you look at your credit report, it will list 2 years of inquiries on there, but really it's only the last 12 months that has an impact on your score.
Yeah. Yeah. And really looking at, the five biggest credit mistakes, is trying to like boil it down into like, here's the biggest mistakes that we see. So maxing out your credit card, and I see this often where people are like, oh, well, I just wanted to keep it on one card. So I only have to make one payment. But if you can spread it out over the cards, if you have a balance, then you're better off doing that. So it keeps your balance to limit ratio lower on them, even though it's the same amount of utilization on there.
Yes.
And then making, minimum payments, that you really got to be careful for many reasons. I mean, the interest that you're going to be building, if you continue just to make the minimum payments, oftentimes that minimum payment's not even paying for all of the interest. So it's
Yes.
going to continue to build on there as well. Is there any negative impact to just paying the minimum payments for credit scoring?
Um, I I would say mainly just not paying down the balances and it affecting your utilization. Otherwise, I tell people usually set your auto pay to the minimum payment amount and then make extra payments because the biggest thing I see people missing payments for is they set it for a fixed amount and then that fixed amount doesn't cover the minimum payment because you went and spent $5,000 Christmas shopping or something on the card and didn't think to go back in there and change the amount that you're paying and you're underpaying by $5 and next thing you know you have a 30-day late or a 60-day late or all the way to a charge off by missing just $5 that you realize you thought you were paying your credit card this whole time but you just weren't paying enough.
And a lot of times people are like, oh, I just set it to the amount due. I don't recommend doing that because if you have fraud on your credit card and
Yeah.
someone maxes out your credit card, you just drained your checking account.
Yes.
So
Yeah.
that's why setting it up on the minimum, but knowing when you need to make that payment so you don't get any interest because there is a date that you have to make your full balance, pay it all off by
Yeah.
that date, and you don't have to pay any interest. So you
Yes.
you could have a credit card. We use our credit card for everything because we
Mhm.
want points. I have not paid $1 in interest because
Yeah.
you know when to pay it off. You pay off the balance every month. You don't pay any interest, and you get money. It's
Yes.
great. You get
Yep.
travel points all the time. But setting up the minimum payments is huge. I am finding that there is a lot more credit companies that don't allow it.
Yeah.
And that's super frustrating that that's the case. You may just need to, make sure that someone else that knows when your credit cards are due or have a little template in the house. So if you're sick or something
Yeah.
happens to you, they know to make the payments too.
Yeah.
And then not checking your credit reports for errors is, I feel like that might even be one. I come across all the time people are like, no, I'm good. I'm good. I'll wait until I find a home, full credit. And now they're like, why is that on there? Or that's not mine. And so there is a lot of things that report in error on your credit report. And that's why it's really important to check your credit reports, which we'll talk about how to do that, when to do it. but making sure that all the information is correct, that it's reporting correctly is super important. And then number four mistake is, ignoring interest rates. A lot of times people will, high interest in expensive debt. And oftentimes people will say, oh, I transferred this credit card to this credit card. What was the transfer fees?
Yeah.
They're not aware that there was transfer fees because they didn't read the information, and they actually end up paying more because of the transfers on that as well.
Yeah.
Or, saying I'm going to consolidate all this into one big card so that I can get it pay off, and it may end up even being more cost in the long run. So really being aware of all the cost associated with it, not just the interest rate itself.
Yes.
And then using credit cards for cash advances,
Oh,
so expensive. And a
yes.
lot of people don't realize it. Like,
Yeah.
oh no, I was told I could just pull the money from it. And then they see how much they're being charged for it later. And they didn't even realize that that was a thing. And, if you get into a point of making minimum payments and then something happens in life, as it always will, and you
Hmm.
don't have an emergency fund, now you're pulling cash, now you're even further behind. If you get to that point, that's really somewhere where you got to step back and say, okay, what can I do so that I'm not having to go this direction, that I could pay off the credit cards, and then I can create an emergency fund.
Yeah, it's mind blowing sometimes. So just look at the interest rate on these cards, like average, I want to say it's in, mid 20s, and then your cash advance is even higher than that. I mean, it's just mind blowing.
Yeah, it should be. I think it's robbery. It should not be allowed. And then you see all these ads about pulling money, and it's so easy, just one click.
Yeah.
It's like, oh, all the fees that go with it that they don't disclose.
Yeah.
So let's talk about strengthening and rebuilding credit. I think that there's a lot of people that didn't know. That's normal. I'm
Mhm.
fortunate I got into the business so young, so I became aware of it a lot sooner than most people. But you don't get educated on it. I can't tell you how many times someone says, no one ever told me, which is why I created, a women's wealth group, and we go over these things, and I do a lot of education around it because we need to know these things. My
Yeah.
son, when he went to college, all his friends have no clue. So he's educating his, friends, like explaining how it works because they don't know. If you're in that position, like most people are, you go to college or you start working, and all of a sudden you find yourself in a position where you're like, man, my credit score is not where it needs to be. What are some of the things that we can do moving forward? So that's
Yes.
really what we're looking at here, is a couple of the different action items that we can take.
Yeah, like we mentioned earlier, definitely keeping those old accounts open. So, and then keeping them active. So it's just not keeping them open because the creditors will go and shut them down if you're not actively using them. So that card that's been open forever, put Netflix or something that's a small reoccurring cost on there that doesn't put you over that 10% utilization, and just set it to pay that off, each month. Is a simple trick where they're not going to close it. I had that the other day where I think I had an old Ulta card, and I got a notice saying, at least they gave me a heads up. They said, hey, if you don't use this card by this date, we're gonna, close it down. So I had to go searching for the card because I don't keep it in my wallet, and, make one little charge on it and then pay it off so I can make sure to keep that account still open. So I'm getting the advantage of the age of that account.
Yeah, and that's what I tell people often, because they're like, I don't want the cards anymore. I just want to pay them off and close them, and I
Right.
don't want them anymore. I always say, well, unfortunately, we have to go credit. So, really, just like what you're saying, I always say, just take your credit cards, pick a
Mhm.
bill that you have to pay every single month.
Yeah.
You're going to set that up to auto charge to the credit card. Go put your cards in a safe. If you have to cut them up, whatever you need
Yeah.
to do, put them where you're not going to have them every single day. But you have to remember to pay off that balance on time every single month. So,
Yeah.
you set up, not only do you do the minimum if it allow you, you also put a calendar reminder on your calendar, your phone, so you remember to make sure it came out of the account, because you're in
Yeah.
rebuilding. You can't have a late. And
No.
that way you're building, building those accounts, and you're not paying any interest. It's just as if it was the other way. It just takes some accountability and
Yeah.
remembering on those things. But a great way for those that are like, I just don't trust myself yet, because it
Yeah.
does take time to rewire. There's no shame in it. It
Yep.
takes time to change your habits and what you're doing, and to, choose different decisions. So if you need to
Yep.
do that to make that happen, then yeah, do that.
Yeah.
Disputing the errors on the credit report, again, be careful with those. I think that you should talk with a credit repair company like Sarah's company at Blue Water Credit, because some of them, yeah, you need to dispute errors that are like admin errors or things like that, right? But if it's an account where it's a collection or things like that, it can actually hurt you more if you don't do it correctly. So making
Yeah.
sure you do that with someone's guidance.
What I share too is that after so many attempts, the bureaus are going to just stop looking at the dispute. So if you try to do it on your own and you don't even, and you go and choose something like on their drop down menu, fraud, I don't recognize this, charge, but you're not backing it up with statutes or, some kind of evidence of the error, then you're essentially using up all your lives where we probably could have got it off for you if you didn't use all your turns trying to do it on your own. And then I tell people they'll go for like the low hanging fruit and just go, well, I'll just dispute my inquiries and say I didn't, authorize that inquiry. And then say you dispute a Capital One inquiry, you have a Capital One card, you say fraud, now all of a sudden they close down your Capital One account, and then that account that was helping you, now you just got removed from your credit report. So you do have to be careful in the way that you dispute. Some things could be, yeah, simple like name or address or birth date, but anything more than that, at least talk to somebody that is a specialist in that industry.
Yeah, 100%. And you can go, here's one, and we'll show you some other ones, but you go to annualcreditreport.com and you can pull a credit report from each of the credit bureaus. I usually say pull one from each one every
Mhm,
quarter, just so you have an idea throughout the year without
mhm.
having to pay for any type of reporting on there, just to make sure everything's correct. Is that what you would say too?
Yes,
Yeah.
absolutely.
And then pay off past due accounts, and just, avoid multiple new credit applications. Now, past due accounts, again, and if it's a collection, if you pay it or not, it's still going to report as a collection unless they delete it. So oftentimes if you pay off a collection, it could hurt you depending on what you're doing. So again, you need guidance when you're doing those type of things to make sure that it's being done correctly and that you're going about it the right way. Now, if you call them and you say, "Hey, if I pay this, will you delete it from my credit?" and you can get a letter from them or something in writing showing that that they will delete it, then
Mhm.
that's fine, because
Yes,
then you have something to show that it's coming off of your credit.
yeah,
But just being paid is the same and worse because you just reactivated it.
yeah,
So you want to make sure that you're dealing with specialists in these situations. I have it where people try to work on their credit and they're like, I don't understand. It's not getting better. It's getting worse.
yeah,
Things like that. That's why. And so
yeah.
it's worth the investment of dealing with someone that knows what they're doing to make sure it's done correctly, that it stays off long term, and that you're not spinning your wheels on it too. Because there is a lot of information on the credit report that could be wrong too.
Yeah.
So maybe if we want to talk just about, as we kind of start to wrap up here, some
Yep.
things that we can do to boost up credit scores.
Yeah. So these are some real simple tips that anybody can do that you don't need a specialist to help you with. Some of them we've kind of touched on, but just to go over them again, that number one, don't miss payments. One derogatory account, that is a deal breaker right there. And you can see your score drop 80 to 100 points. Higher your score is, the higher impact it's going to have when you miss that first payment after multiple. You stop losing points at some point, but you're going to get hurt the most with that first derogatory account. A lot of times, again, we see it by either underpaying the minimum payment or forgetting that there's an annual fee and not having it set up for a minimum payment. Maybe you didn't close a card, you knew to keep it open, but you forgot every year you're hit with that $99 fee. And so the statement comes, you just shred them without looking at them and forget to pay it. And so, yeah, making sure even those cards that you're not actively using, set it up at least for a minimum amount due, so that you're not missing those unsuspecting charges that can come across it. Number two, paying down credit cards. So I mentioned earlier, trying to keep the balance to 10% or less of the limit. A little workaround to that is if you're short on funds, it doesn't hurt to maybe call your creditor, especially if you have a good payment history with them, to just see if they can increase your credit line even a little bit. Every bit that you can go up is going to send your utilization down. So that's a little trick we tell people. Obviously, if your credit score's low and you're missing payments, they may not let you do a credit line increase. So and most of the time it should be a soft inquiry, but even if you have to take a 1 to 5 point hit, the points that you make up and getting that utilization down is probably going to be more than that. We mentioned paying multiple times during the month, or I also mentioned paying early. So what happens is when your statement comes out, whatever balance is on your statement is typically the balance that gets reported to the credit bureau. So if you're like most people, you get a statement and then you pay your credit cards. My dad is one of those people, and he puts everything on his credit card for the points, like you mentioned. And then he pays it off and goes, Sarah, I don't understand. Why is my utilization so high? I pay everything down to zero every single month. I'm like, well, Dad, you're not really getting the credit of paying it down to zero because it's kind of a revolving door of charging, paying off. If you wanted it to recognize that the utilization went down to zero or whatever it may be, you have to make the payment before the statement comes out. So you don't have to do this all the time, but if you are trying to show lower utilization to, gain some points for your loan right now, going on maybe a week or so early and paying the balances at that time or making the multiple payments throughout the month. Um, Third is authorized user. So we use this a lot of people that are just getting into the credit space, whether they are 18 or maybe they just are new to credit, that you can have somebody add you to their credit card and you inherit the credit card history for that specific card onto your credit report. So it's like you've had that card for 20 years, just like they have. So this can build, a good mix of credit, length of credit, just credit history in general. But in the same token, even if you're not using the card and somebody else is the main user of that card, if they drive the debt up or miss a payment, it hurts you just as if it was your own card. So sometimes we have to walk people through how to remove yourself as an authorized user as well.
And another
Next,
thing to add on that too is just if you are going to be, applying for a mortgage or doing something like that, be aware that it's now a debt under your name.
yes,
So if it has a payment, you want to make sure whoever does it that they pay it off each month,
yeah,
and that they keep a low balance, because if it has a payment that reports on there, it's now your payment that you have to qualify for, or
yeah.
we have to go through removing you as an authorized user to be able to exclude that payment if you can't qualify with it.
Yeah, I always say talk to your lender because that new payment might go to your debt to income ratio where that disqualifies you for getting the loan. So you got to see where the importance lies. Is that debt going to, count against you? I know in some cases you can write a letter of explanation, but again, that's always why you want to have good communication with your lender, and knowing that, yeah, if you have to get removed and it was a card that was helping you, that can drive your score down too. So you need to make sure you're being very proactive in all these different fields to be building up your credit. Next would be just opening an account. So we usually walk people that are either new to credit or have all these closed collection accounts, is opening a secured card is a good place to start. And it doesn't have to be something with a huge balance. It could be $250 because you have to send in the money as a deposit. And some people think, oh, my payment just comes out of that deposit. No, you still have to pay it like a regular credit card. So you need to charge on it, make a payment. That is just there as an insurance method. And then usually after a year or so, they will roll it over into an unsecured card. And sometimes then you will get that deposit back. But that's a good place to start with, your local credit union, or we do have links on the Blue Water Credit website that has high approval ratings. The other is something called a credit builder loan. So this is a great option if someone doesn't have a installment loan, like a car loan or a student loan. It's a product where you're essentially paying yourself into a savings account. We have one that's like $15 a month, but then it reports like it's an installment loan on your credit. So now this gives you that mix of credit without necessarily having to take on a new debt. And like I said, it can be a $15 payment minimum. So hopefully that's not affecting your debt to income ratio, showing that payment on your credit report. And although I mentioned right now that the mortgage space does not count rent and utilities, the new scoring models will. And then plus those kind of adding those type of things can help you get the credit card that you need to even first start building your credit, or to get that auto loan, or to get that rental. So not everybody's in this space to buy a house right away. So putting those things on can make you have a higher approval rating for the things that you need to get before getting that home loan. And then last, making sure you're not closing those old accounts. We talked many times before. They look at the average length that your cards have been open. So they just say, hey, card one's been open 2 years, this card 6 years, this card 10 years. They add up the total length of time, divide it by however many cards there are, and they want to see 6 or more years to get you a good account history. So when you close off those old accounts, your average age is going to drop, or anytime you open new accounts, that's going to offset your old accounts. So keeping those old accounts open, keeping them active, making sure you're using them every couple of months, so that you don't have the creditor close them down on you, or you just don't have, if you don't have activity, even though they may not close them, they can be taken out of the calculation of your credit score because there's just no credit history for the last 6 months.
Yeah, definitely something to be mindful of.
Yeah.
And these are the different ways that you can pull credit. So we already talked about the annual credit report, which you can go in and pull from there. It doesn't give scores, but you can pay extra to get your scores if you wanted to. Identity IQ and myfico.com. Any extra information you want to give on
Yeah,
differences?
so I let people know Identity IQ, we use that a lot with our clients just as far as for monitoring credit because it includes all three bureaus. It's a very clean and easy report to read. It will update you when there's changes. I believe we have it on special for like under $20 a month. So it's a good monitoring, but again, it's the Vantage score. So it's not the scores that they include are not going to be like your mortgage scores. But if you truly want to know what your mortgage FICO scores are, maybe you're not working with the lender yet, or maybe they don't have the ability to do a soft pull. The last place to go is at myfico.com because you can pay about $60 to get a one-time report and it will give you all those FICO score versions that we saw on the slide earlier on this presentation. So you can go and scroll down and figure out what your mortgage score would be if your lender had pulled it today. And you can give you a really good idea of where you stand instead of guessing like if my Vantage score off or my FICO score 8 a little bit different. So if you are planning on a big purchase, that is the best place to go. If you just want to monitor it for educational purposes, Identity IQ and then annual credit report, great free tool. You can pull it once a week. I even suggest it for kids that are between the ages of 14 and 18 because people out there use people's social security cards and you don't want to go and have credit pulled and then have these things pop up. So if your child is at the least age of 14, they will show if you have them as an authorized user on there and have like a credit report before the age of 14, nothing should show up. But it's good to just stay on top of that with all the identity theft that's out there because the last thing you want to do is apply for something and then get hit with oh, I didn't realize that was on there. That old Comcast bill, that old AT&T bill, it happens all the time.
Yeah, it does. There's, like I said, a lot of errors that come up. So it's good to be proactive and make
Yeah.
sure you're looking at your information. So really the key takeaways from all of this, because I know it's a lot, I know it's overwhelming, I know it's like, is really just to figure out what were the things that really stood out to you that really resonate with where you think you are, start there. Then go back and do the next steps, because I know if you get too overwhelmed, you're less likely to take action. So really just focus on what are the one or two things that we can do moving forward. So checking your credit report first, just to go through and see what's on there. Some people may not want to check it. They're just scared to see what's on it, but you got to know where you are in order to move forward.
Yep.
There's nothing that's going to jump at you or, hurt you. It's just a matter of knowing where you are so that you can decide what you want to do moving forward. I always think it's a good idea for you to freeze your credit. You can go on to each of the credit bureaus and do that for free. It's a pain sometimes when you have to unfreeze it to pull credit, but it's worth it. And that way you can prevent other people doing anything fraudulently on your card. And making sure that as you're building credit, that it's not preventing you from building your credit. Set up auto pay. We talked about that. And then keeping your utilization. If you're building credit, you said under 10%.
Yeah.
But if you have good credit, I mean, really, you just want to stay under the 30%
Yeah.
as well. And final thought, good credit is more financial freedom. It gives you more life choices. It gives you lower rates, lower costs, lower fees, so that you can be able to build more from there. Last final piece that I want to talk about is helping your kids build credit. I think that this is where it starts. So if you're learning credit, share it with your kids. When they're young and they're starting to build credit, when you're in a position that maybe you have a really good, credit card, you've had it for several years, you keep a low balance to limit ratio, you can add them as an authorized user. So for me, that's what I did when my kids turned 16. I added them as an authorized user. When they turned 18, they got their own credit card, started managing it. My son got his second credit card when he turned 21, I think. And he was shocked because he got like a $20,000 line of credit. And I'm like, but he understands not
Yeah,
using
he's
it. He
already
knows,
responsible because
yeah.
you taught him.
Yeah, he's like, well, I would never, never be able to use that amount. I'm like, well, but you just, the things to teach them though is like, so here's the date. You need to find out what day of the month you need to make sure it's paid off before, so you don't pay interest. You set up the minimum payment to make sure that it always makes a payment, and you never let a balance move to the next month. I always tell them it's not an emergency fund. It's a way that you can fund things to prevent fraud, because really I think that's what we use it for. I know that's why I use mine. Is I don't ever use my debit card unless it's something that won't take a credit card, because it's not as easy for somebody to steal from a credit card. If they can, you can dispute that and they don't take all your money. So using it as a tool is really important. And just making sure that you always pay on time. That one late can really, really, really hurt you. So even maybe monitoring them and just kind of seeing, as they build to make sure that they're on the right foundation,
Mhm.
making those decisions. And if you see them spending a lot, you're like, where's that money coming from that you're
Yeah.
spending?
I don't see you working enough hours for that purchase there.
But it puts them in a good
Yeah.
position and you're helping them and helps them build credit so that, they could start making those purchases that are going to make them more money in the future. Good credit, more financial freedom. And, you start small and you build wisely and you can always rebuild. I
Mhm.
think that that's the other thing too, is so many people are just scared of starting to rebuild. It will take time, but you can do it. And pairing with a good company like your guys' company at Blue Water Credit to do that is really important to be able to do it even faster and make sure you're
Mhm.
doing it the right way.
Absolutely.
It's not scary.
No.
You just got to know what you're doing and take one action at a time.
Yeah, I tell people you can't change what you don't track. So if you don't even know where to start and you're not looking at it, how are you going to know to change it or if you're making the right
Yep.
changes and
My
choices?
my coach says if you don't track, you don't care.
Yeah.
And unfortunately, this world we have to care, or you're going to pay a lot of
Yeah.
money. uh, well, thank you, Sarah. I appreciate
Yes.
your time. I know it was a lot of information to go over. You're going to help so many people, and I am so thankful for the time that you spent here today.
All right. Yeah, of course. Thank you for having me.
Awesome. Thanks so much.
All right.